Hi, everyone. Welcome to the fourth quarter 2023 market update. A lot of things that happened in the fourth quarter. So some of the key takeaways that we saw were really that the S&P 500 and the overall market got on a nice run. In the fourth quarter, we saw an 11% return for the S&P 500, which put it for a total for the entire year at 26%. Now, considering 2022, we had a negative 18% return. That is a huge turnaround. Now, a couple of the main topics that we saw throughout 2023 were inflation and interest rates. So when we look at inflation, we really measure it by CPI, or Consumer Price Index. Last year, we saw it at 9.1% in June. That significantly decreased here towards the end of the year, down to 3.1%. Now, keep in mind, the Fed is trying to get it to a target rate of 2%. So this was really a great improvement. And we also saw yields retreat a little bit from October 2023. That was kind of the high water mark, and that was the highest that we saw yields since 2007. Now, at the end of the year, the Fed hinted at potential rate cuts going into 2024, just under 1% or 75 basis points. And the bond market returned after a really difficult 2022. The bond market in 2023 ended up just over 5%, whereas last year it saw a negative 13% return, which was the worst in bond market performance. Now, the slide here really talks about volatility. There was really a roller coaster of a ride in 2023. And so what this shows is the S&P 500, basically the stock market index, what the returns were month by month. Now, as you can see, even though we had a 26% return for the year, that was not all just linear. There were certain months where there's pullbacks, what we call drawdowns. Now, those are normal. So even though we ended up with a great return, there were certain periods in February, August, September, October that we did have drawdowns. So this is why it's important to stick to your plan. Now, as we can see in this slide, this really talks about volatility in the S&P 500. So when we look from 1928 all the way through the end of this last year, it's basically the Great Depression. We look at the S&P 500 and what the percentage of drops or pullbacks that we saw. So there's 3%, 5%, 10%, 15%, and then what we call a bear market at 20%. So on average, there are 7.2 3% dips throughout a year. When we see 5% dips, that drops a little bit down to 3.4%. 10% corrections, that happens on average just a little over one time a year. 15% is maybe every other year. And then bear markets maybe every 1 in 3 years on average. So really what this slide tells us is essentially what the previous chart said, that there's going to be ups and downs in the market, and it's important for us to stick to our current allocations. Now, on this page here, we'll take a look at bond returns for 2023. Now, remember, in 2022, the bond market saw the worst performance in the history of the bond market. So when we came out January, we saw rates increasing, which tends to be pretty good for the yield or the income that we're going to receive on bonds. But when yields go up, bond prices tend to go down a little bit. So we did see that throughout the middle of the year. But as you can see, once the Fed kind of stopped raising interest rates and even indicated towards cuts, we saw bond prices increase pretty significantly towards the end of the year. And we ended up just over 5%. Now, again, here's another chart to really drive home the point of the ups and downs of the market and how important it is to stay invested and stick to your current plan. So what we're looking at here is annual stock market performance from 1928 through the end of this last year. And so over here, we can see end of 2022 at negative 19%. And then we flip that over to the end of this year at a positive 26%. So you can tell by the bar chart here that typically the stock market has positive returns, but it is important that from year to year that can change, and it's important to stick to your long-term plan. Now, on the bottom of this chart, it's the same exact thing, but it's for the bond market. Now, the bond market is typically more conservative. You're going to see maybe less of a spread. And so that's why you can see more concentrated returns here in the middle of the chart. Now, again, as we pointed out earlier, last year we saw negative 13%, which was the worst we've seen for the bond market. Yet this year we saw just over 5%, which is really right in the middle of the pack. Now, of course, 2024, it's an election year. So a lot of people tend to get a little bit nervous going into an election year. You know, they worry about the market, who's going to get elected, is it going to be the Democrats, Republicans, what's going to happen with the markets? So Vanguard has this great piece that really talks about a moderate portfolio, which is 60% stocks, 40% bonds. What typically happens in an election year? So this goes way back to all the presidential election years that we've seen versus the non-presidential election years. And as you can see, during presidential election years, over those 41 periods, this portfolio of 60% stocks, 40% bonds, on average has returned 8.7%. Now, when we look at those non-election years, or 122 periods, we see that the overall portfolio generated 7.7%, so a full percent behind election years. So when we talk about volatility, yes, we tend to see a little bit more volatility when it comes to election years. But when we look at the averages and what's happened in the past, we tend to see pretty strong performance. So what can we expect here in the first quarter of 2024 and really for the year ahead? As we just talked about, 2024 is an election year, and the markets have historically performed pretty well in these years. Now, with election years, we tend to really see a little bit more volatility. And as we explained earlier, it is really important to stick to your plan and really look at your asset allocation. We go through and rebalance. So when stocks like last year outperform a little bit, we peel some of that off, take some of our gains, reinvest, and get back to our standard allocation. Now, it's important to be diversified too. A lot of times you can look and say, wow, the stock market returned 26% last year. Should we put more into stocks and less into bonds? Well, the important thing about diversification is we don't know what will happen in 2024. So if bonds tend to outperform stocks this year, it's important to still have allocation there. And we do have a good indication that bonds will perform pretty well this year. So when we look at the U.S. economic growth, it's projected to slow down a little bit this year. There's a little bit of anticipation at the end of last year, and that's really what kind of drove the market. But this year, interest rates are still relatively high, and so we see a little bit of a slowdown in the overall economy. Now, we are looking at a softish landing for the economy. Now, really what that means is we're looking to avoid a recession. So since 1971, as you can see here on the slide, there's been 7 cycles of interest rate hikes of more than 2%. Now, in 2 of those cycles, the U.S. has been able to avoid a recession. A big part of being able to avoid the recession in those cycles was having a strong labor market, really getting inflation under control, and households really doing a good job with their savings. Now, from what we can tell, these 3 factors are under control and in a good spot. So a lot of the analysts are really seeing a softish landing and the ability to really avoid a recession in 2024. Now, really, the final point that we'll talk about is interest rates going into this year. Now, the Fed has indicated that they are looking at making rate cuts, which tends to make sense, right? And it's an election year, and the Democratic Party, regardless of who it is, they want the stock market to do well and overall really help their election efforts. So when the Fed reduces rates, that has typically a positive impact on stocks, right? Interest rates are lower, so people can borrow money at a lower rate. Businesses can borrow money at a lower rate and grow their businesses, expand. And then when we look at the bond market, when rates come down, bond prices go up. So when we look at our bond portfolio and we look at total return, this is an important factor as we look at overall portfolio growth. So again, 2023, we had a great year in the stock market, a pretty moderate year in the bond market. We'll see more volatility this year in 2024. And again, it's important to stay diversified, stick to the path, and really follow your financial plan. So I hope you enjoyed this market update, and we'll see you here in a couple of months as we review the first quarter. Thank you.